it is a paper about international financial spillovers to emerging market economies. In a nutshell, we want to understand the drivers why, during periods of global financial stress, some emerging markets get hit more than others. And in particular, we are going to look at the role of the macroeconomic fundamentals and the ability to explain this differentiated response of financial markets in emerging market economies during periods of global stress. So, just a brief outline. We are going to have three main questions at which we look in this paper. So first we want to explain, we started off by focusing on the so-called taper-tantrum episode in the middle of 2013. So from May to August, the Fed gave the first signals about tapering the pace of LSAPs. And the episode in May was particularly harsh for emerging markets. We want to understand what explains the differentiated response. For the second question, we are going to zoom into the episode, into the 2013 taper-tantrum episode, and we want to explore the timing and the persistence of this differentiation process across emerging markets. And finally, for the third question, I think this is the most interesting part of the paper. Given the findings on the first question, we do see that fundamentals did matter. We go back to past episodes of financial stress, starting in the mid-1990s. And we want to see if a similar differentiation occurred based on the same fundamentals in the same sample of emerging markets. We want to see if something similar occurred back during the crisis from the past, not just during the taper tantrum. So just to illustrate what I'm talking about, I'm going to show some time series here about financial variables from emerging markets. So in the first panel, the bars represent the so-called this is a proxy for capital flows to emerging markets. So we have the emerging market fund flows from EPFR. So you see the May 22, 2013, that coincide, starting in May, the flows to emerging markets reversed and became sharply negative, right? So from May to August of 2013. In the bottom panel, seeing what happened with the EME exchange rates, that is the black line, and the EME equity indexes, the green line. So again, looking at the May 22, 2013 episode, you see sharp depreciations in the EME currencies and sharp declines in the stock markets. And finally, let's look at the sovereign bond sovereign bond yields. The black line is for the United States, and the red line is for the emerging markets. So see how in May 22nd there was a sharp increase, in the U.S. Treasury yields, but an even sharper increase in the EME sovereign bond yields. That started in May 22nd. So, however, looking across emerging markets, this is just this is what I mean by differentiation. So in the bottom left panel, we see some emerging market exchange rates against the US dollar. So up means currency, the emerging market currency appreciation. So you see how during the May and September of 2013, there was sharp depreciation in the currencies of some markets, including for the Indian rupee, the Turkish lira, and the Brazilian real, right? But the currencies of other countries like Korea and Brazil were more resilient. And also with the government bond yields, so see how in between May and September, the bond yields of Korea, for example, increased but rose by less than, for example, the bond yields of Turkey and Brazil. Okay, so we want to explore in this paper what explains this differentiation in the cross section of emerging market economies. So a sneak preview of findings. So controlling for, so we see that emerging markets with better fundamentals suffered less during the taper tantrum episode. We look at a few hypotheses in parallel. So fundamentals mattered. Second, controlling for fundamentals, that is so-called more in, more out. There's this so-called more in, more out hypothesis. So what explains the sharp outflows? The hypothesis says maybe those emerging markets that receive more inflows during good times, those emerging markets suffer more outflows during the taper tantrum. Or also there's this hypothesis about the financial market structure that would have mattered. For example, emerging markets with larger capitalization, with more liquid financial markets, were the so-called proxy markets from where investors pulled first when they had to rebalance their portfolios. So while controlling for this, while exploring these three hypotheses in parallel, we do see that fundamentals matter most. But we do see evidence that the other two hypotheses were at play as well. So for the second question, differentiation set in early during the episode and persisted throughout. But more importantly, so looking at past episodes, we see little episodes. So for the same sample and the same fundamentals, repeating the methodology for past episodes, we see little evidence of differentiation during the 1990s and the early 2000s. But we see more differentiation starting during the global financial crisis in 2008, and then increasingly during the European sovereign debt crisis in 2011, and then differentiation peaked during the taper tantrum. So just okay. So very briefly on the literature. So we do have a couple of papers about the taper tantrum already, and the results in the literature are very diverse. So I've underlined the findings on the role of fundamentals. So for example. So one paper finds that fundamentals play no role, right? The fundamentals, where the macro fundamentals are those in the brackets, but they do see larger ex-ante increases in current account deficits matter. So countries that previously experienced larger increases in the current account deficit suffer more during the taper tantrum. Well, the current account is a fundamental. So fundamentals play no role, but they do see that the current account mattered. Another paper shows that in the very short term, so this is a difference in methodology, so in the very short term after the news shock, countries with better fundamentals actually fared worse. But the paper does acknowledge that in the longer term, better fundamentals actually helped. Right? And then there's a paper by Prachi that indeed other papers find that countries with better fundamentals fare better during the taper tantrum. So given this diversity of results, I just wanted to, take a step back and say, what explains why there's so many results and so many, why the divergence of these results? So the way I look at the literature, some of the divergence can be explained by different papers using different definitions of fundamentals, like the current account in levels or changes is an account of macro fundamentals, right? The measurement of fundamentals, like are we using a continuous measurement of fundamentals, or we rank country by fundamentals, or we split them into two bins of robust and fragile countries? Well, these kind of differences in methodology also could drive different results. Dating the stress episode also makes a difference. So it turns out that the results in the very short term are different than the results if we measure the financial stress from the peak to the trough of the episode. The sample size might induce some of these differences, and so on. So what we do, very simple, in the cross-section, so we're going to regress the change, so we're going to take the financial variables enumerated here. So we're going to look at currency depreciation. We're going to build this depreciation pressure index also that takes into account not just the actual depreciation of the exchange rates, but also the intervention by the central bank, given by the decreasing reserves, is going to enter this index positively, right? So higher depreciation pressure is backed out not just from the movement in the exchange rates, but also from the central bank intervention that was meant to prevent these depreciations. We are going to look at the increase in local currency bond yields, change in stock market index, and change in the MB and CDS spreads on government debt. So we are going to, so in different specifications, we are going to run a cross-sectional regression where on the left-hand side, we are going to have the change in these financial variables from the beginning to the end of the episode. And among the explanatory variables, we are going to have the macro fundamentals. We're going to have variables that back the more in, more out hypothesis, and also variables that measure the variables of market structure in emerging markets. So a bit more on the explanatory variables, what I just said. But then among the explanatory variables, so we're going to include 6 macro fundamentals: the current account to GDP, short-term external debt normalized by reserves, the amount of reserves themselves normalized by GDP. We look at gross government debt, we look at inflation, and we look at the run-up in bank credit over the previous year, in the years leading up to the episode. Right? So we use those fundamentals, either all of them by including them in the regression, or we're going to build this index of vulnerability based on these fundamentals. So how we build our vulnerability index is it's an index of relative vulnerabilities across emerging markets, where we rank the emerging markets according to each of these macro indicators with higher rankings, meaning more vulnerability. And then we are going, for each EME, we're going to take the average ranking across the 6 indicators, and that's going to be our vulnerability index. So when this is our sample of 20 emerging markets. So again, one factor that limits our sample is data availability, but data availability not just for the taper-tantrum, but data availability going all the way back to the 90s, because we want to freeze the sample and use the same exact financial variables and macroeconomic indicators in order to run the analysis, not just for the taper-tantrum, but also for crises in the past. Just a visual depiction of, for example, the exchange rate depreciation. So on the vertical axis, we have exchange rate depreciation for our sample of emerging markets. And on the horizontal axis, we have the 6 fundamentals. So you see how countries with larger current account deficits experience, during the taper tantrum, right, experience more depreciation, countries with less reserves, or countries with more short-term external debt to reserves experience more depreciation. Countries with more government debt suffer more. And also countries with higher inflation suffer more. So these are the kind of relationships between fundamentals and the financial variables during the episode itself. So there's a similar relationship for the increasing government bond yields, especially for the first 3 fundamentals. But we do, so these are the results from our cross-sectional regression. So in the first column, just let's focus on, in columns 1 to 6, on exchange rate depreciation. So we either include the 6 fundamentals by themselves, that's in column 1, as explanatory variables, or include our vulnerability index in the second column, right? So you see that some of the fundamentals came out statistically significant, not all of them, right? So the current account deficit countries with with larger deficits depreciated more, in countries with more government debt. But then the vulnerability index, so a higher index means more relative vulnerability, right? Those depreciating more as well. And when for the more in, more out, and for the financial structure variables, also, for example, more in, more out means we take the cumulated gross inflows over 2010 to 2012, right? They're normalized by GDP. So the more controlling for the vulnerability index, the more inflows they received, the more they suffered afterward during the taper tantrum. And also the extent of real effective appreciation explains some of the depreciation during the episode itself. But when we don't do this here, but when we run univariate regression to see what gives the higher R-squared, well, we see that the vulnerability index explains more than a lot more than the more in, more out, or the financial structure variables. Okay, so just for the bond yields, we find something similar. So the vulnerability index enters positive. More vulnerable countries had higher increases in the bond yield, and also some evidence that the growth forecast. So the more growth the growth outlook deteriorated for 2013, the more they suffered. And also, the more they appreciated prior to the episode, the more they suffered during the episode in terms of an increase in the bond yields. But again, we find that our vulnerability index explains more than the other variables. The second question, very brief. I'm not going to insist on the second question. For example, take the depreciation pressure index, and we're going to look at it. We're going to zoom into the taper tantrum episode. And first, we are going to have a measure of cumulative stress for the depreciation pressure from the beginning of the episode in April. So we're going to compare depreciation pressure experienced from April to May, or from April to June, or from April to July, so cumulatively into the episode. And we see that differentiation set in early into the episode and continued throughout it. But also the incremental stress, so-called incremental stress, we slice up the depreciation pressure monthly for every month within the episode. So we see that the depreciation pressure set in early into the episode, right? So the incremental stress occurred early. And then for the third question, what happened during past stress episodes? So we're going to identify past stress episodes. We don't pick up the dates from the literature necessarily, but we're going to use 3 variables. So we're going to use VIX, we're going to use an exchange rate index for the emerging markets as a whole, and we're going to use a stock market index for the emerging markets as a whole. So we're going to look at abnormal movements in each of these 3 indices, And when 2 out of the 3 indices point to an event, point to abnormal movement, then we're going to take that as an event defined. The peak is the start of the event, and the trough is the end of the event, right? So these are the criteria. This is the algorithm that we ran with the three indicators to identify events. So this is what we find. So we find the blue lines, right? We find 13 episodes of financial stress, and we are going to focus on 7 well-known episodes. Right, so what we identify the Mexican financial crisis, we identify the Asian crisis, we identify the Russian crisis, the Argentine crisis, the global financial crisis, the European sovereign debt, and the taper-tantrum itself. So again, we don't pick the start and the end dates from the literature, but we identify ourselves abnormal movements in those 3 indicators, and we pick the beginning and the end of the events ourselves from this algorithm. And those coincide, the dates coincide with what we see in the literature. So, and again, we regress the depreciation pressure index for the same sample of countries, right? The depreciation pressure index built the same way with the same macro fundamentals, and using the depreciation pressure index built the same way for each of the events. So we see no relationship really between the vulnerability index and depreciation pressure, right, during the past events, during the Mexican crisis or the Asian crisis. But we see, so these are the coefficients here in the bar chart. So the coefficient increases in size and becomes statistically significant during Lehman, and again during increases in magnitude and still significant during the European sovereign debt crisis and the taper tantrum. So this, if you want, these are the previous results put on a scatter plot. So these are scatter plots for each event, 94, so Mexico, Asia, and so on. So you see the scatter plots between the vulnerability index at the time, right? The vulnerability index using the macro fundamentals at the time for those countries on the horizontal axis in each scatter plot, and depreciation pressure on the vertical axis. And you can see how the relationship between the vulnerability index and the depreciation pressure shapes up more and more, increasingly so over time, and the line becomes more obvious starting with the global financial crisis in 2011, 2013. Okay, so that's the conclusion. I mean, we do see that differentiation during episodes of stress or during the taper tantrum was related to country-specific fundamentals. We do develop this index of relative vulnerability. We find the evidence of differentiation for the 5 financial variables, for all the financial variables except for the stock market index, right? So we don't see differentiation based on stock markets, but we see it in exchange rates and bond yields and in the spreads. Controlling for fundamentals, the more in, more out hypothesis and also financial market structure have some traction, but we see that fundamentals matter most. And also we see that differentiation evolve over time and has become more and more of a pattern over time starting in 2008. Okay, so thank you very much.
Just begin by summarizing the paper. So the main question which this paper asks is, do markets differentiate across emerging economies? And in particular, Andrei and his co-authors look at the 2013 taper talk episodes. But what is unique about Andrei's papers, also they look at past episodes of stress. The methodology is incredibly simple. Just simple, I think there was some discussion on OLS versus matching. This is like incredibly simple, Ugo, it might, satisfy you. Incredibly simple OLS regressions with 20 observations. So the main findings, macro fundamentals do matter in 2013. In particular, current account to GDP and government debt to GDP matter. They also build a nice thing about the papers. They build this composite index of vulnerability, and what they find is the more vulnerable a country was, it reacted more around the taper talk episode. What I find interesting is that they also look at within 2013, And they actually show that differentiation started quite early, which is again, which is in contrast to perceived wisdom that, actually there was herd behavior in the beginning and then differentiation started. They are saying that actually differentiation started quite early in 2013. Then they find that it reversed in September, October, but eased by the end of the year. Again, another interesting finding is that so the less vulnerable countries reacted less not only around negative events, but around positive events as well. By positive events, I would mean September, October, when the Fed said that, we are not going to taper. Then on the historical episodes of stress, they define historical episodes of stress based on unusually high periods of volatility based on VIX and some other variables. And what they find is that episodes since the global financial crisis were unique in terms of market differentiation. So I should say that it's definitely an important question. The accepted wisdom, to my knowledge, before this 2013 taper-tantrum episode was that the emerging markets represent one asset class. So the evidence which Andrei and his co-authors have presented actually questions this wisdom. And there's a nascent but a growing literature on this topic. I think Andrei did a very nice job in describing, the papers in the literature. So these are the papers in the literature. Typically, they differ in, how, I think Joshua also has a paper where he's looking at tapering news. You and your co-authors actually have a, slightly counterintuitive finding that robust group was more exposed to news about tapering. Then, of course, there's work done by Econometri and Gupta who argue that macro fundamentals don't matter. But as Andrei said, they actually show that current account deficit matters. So, it's not clear why they say that macro fundamentals don't matter. And, there's some work I've done with co-authors where we focus mostly on financial depth. So overall, my reading of the literature is that, there is consensus that markets differentiate across emerging markets during periods of stress. And that emerging markets are no longer single asset class. There's less agreement on what variables matter and in what direction, and what are the magnitudes. Contribution of the paper by Andrei and his co-authors is that it's shedding light on the same question, but the contribution is to look at different time horizons within the 2013 episode itself. Of course, the finding within the 2013 episode is unique to their paper. And of course, as I said earlier, it questions the general wisdom that there was initial herding of investors followed by discrimination. Again, looking at historical episodes of stress, not many papers have done that. The one thing is that the results they find are actually different from the GFSR. So this is something you could look into. So let me make 5 quick comments. One thing, and this comment I've made before as well. So what is the null? How do these, what is the market reaction during usual periods? So that to say that, the reaction is actually unusual during periods of stress. So what is a non-event, and, how are markets reacting during normal periods, and whether differentiation matters, whether country characteristics matter during normal events, is something I think we need to understand better. So basically, if you're looking at changes in variables over 1 to 3 month period and correlated with country characteristics, it does not tell us anything about how fundamentals matter relative to usual times. So if you can pool events even within a year to say that, okay, during non-events, this was the market reaction, and actually during negative events, the reaction is very different from what it was during, non-events. The other point is that, looking at long time horizons, of course, this is the usual critique that if you're looking at 1 month, in this day and age where people are looking at intraday data, I think looking at a long time horizon might be subject to the critique that, you are confusing the impact of other events. So I think you described very well the different studies that exist in the literature. I did not get a sense of why, your results differ from some of the other studies. And, is it different methodology, different sample, or different definition of events? This, I think we need to understand why. So in a sense, you would have to condition your study to the same sample as other studies have done to show that even in their sample, you find the same result. Or, doing a methodology or definition of events may be difficult to do, but the minimum you could do is that, it's not the sample, which is even if I use these other samples which these papers have used, I'm going to find that, the finding is going to be the same. The third thing is you could, given that you're looking at a host of variables, you could look at financial depth as well. And did countries with deeper financial markets react more or less around periods of turmoil? And here, the story could go either way. If you have large liquid markets, of course, sell-offs are more likely, and the market reaction could be much more, during periods of stress. However, there's another story possible that, deeper financial markets could provide the cushion, and countries with deeper financial markets could react less around these periods of stress. And this is just, looking at the exchange rate change between May to September 2013 and looking at plotting it against the FX turnover, which is one of the indicators of depth of these markets. And you actually see a negative relationship. There are actually countries with deeper financial markets reacted less around the taper tantrum episode. So I think given that, you are looking at a host of variables, I think you could look closely at financial depth as well. My fourth comment is that, understanding why markets are different, why are markets differentiating this time around, or why are markets differentiating since global financial crisis, or why does differentiation increase over time? Is it because the nature of the shock? The nature of the shock has changed. If you look at the global financial crisis, the shock originated in the US, or is it changes in investor behavior? So I think it would be really, maybe not in this paper, but in follow-up work, one could look at, why is this happening? And again, using micro fund level data on investor behavior could be one of the, directions to take. And again, my last comment is that, if I look at this evidence of increased importance of macro fundamentals, does it mean that I can rule out the herd behavior story? Is it, is it an either-or story, or it's a mix, or the mix of the two? For example, as I mentioned again, the GFSR 2014 April, they use micro fund level data, and they look at herding behavior, which they measure by the extent to which certain group of investors trade in the same direction more often than one would expect if they traded independently and randomly. And they find that actually herding behavior has increased continuously since 2000. So how do I reconcile increase in herd behavior with evidence for increased differentiation over time? And what do I make of the results? So with this, let me conclude. I think overall, it's a very important question. You have new, interesting results. Maybe there's scope for further work, maybe not in this paper, but in other papers, looking at, new methodologies, maybe event studies, pooling events so that you can actually get you can get non-events during in your sample as well, so that you could say how countries behave during normal times and how is this, how it differs during episodes of stress. I think better reconciliation with some of the other studies, new measures of financial depth, and these, dig deeper into why is differentiation a more recent phenomenon, and why has differentiation increased over time? And finally, can we really rule out herding? If does differentiation by investors across countries imply that it's, we are ruling out herd behavior, or it could be a mix of two?